All right, class. We're talking about entrepreneurship. We're going to finish covering up the financial aspects of business, part of the capital. That's where we ended last, and that's where we're going to move towards. Remember, we ended in the last video talking about some of the capital. We were talking about banks where we ended. So now we're moving to the next points that we discussed, and some of them are we credit unions. All right, it's pretty similar to the banks. And we're going to do this quick and fast, over 10 minutes or less. All this is a quick review. Banks, credit unions are similar to banks. That's what we need to know. So main thing right here, let's get the highlighter out really quick. I know I'm taking wasting time. Pick a color. We're gonna go with purple. Right here, banks. Similar criteria as banks. That's the main difference right there. You need it's not the main. It's the main thing you need to know about credit unions. There's no difference in what they're gonna do. Now, what they're gonna offer you is a major benefit if you can get a loan, because not all credit unions do business loans. If you find one, is often lower interest rates. That is the key thing that saves you money, puts money in your pocket, so you can reinvest and purchase inventory that you need, that customers want, that can then make you more profit. So that is a key importance. Now, it is difficult to get a business loan for credit unions because you have to be a member of that credit union or know somebody that is a member. It's not easy to do so, but understand that there's a big benefit between credit unions and banks. The biggest benefit overall is lower interest rates. Everything else is going to go right back to what we discussed. Other criteria of banks: capital, collateral, capability, character, coverage, and circumstance. All those play factors when you talk about credit unions, so just remember that. On to the next part. I put a big old stop sign warning flags all over this place. Why? Because that's what you need to know. I put a big old do not do, but one source is family and friends. I've seen too many experiences on my personal side in my lifetime. It's a bad source. But it does have to be done sometimes, and it does work out for others, not for everybody. I think percentage wise, it's more negative than positive, but there's been successful people who have done it using family and friends as a source of capital. Very common for first time business owners. They do often ask family members. Normally, a lot of times you'll see individuals get their parents to give them assistance. So that's the key thing right here. You normally see this for first-time business owners. That's the key thing you want to know right here. First-time business owners. They need assistance, financial assistance. They're not established. They're not ready, but they know people. Huge caution. That's why you see all the stop, red flag, use with caution, be aware, be careful. Everything you see. The easiest way to lose a friend or a family member is to lend them money and borrow the money. You know that's true. You go ask anybody, go ask your parents, ask people. It's the easiest way to lose a friend is to for you to lend it to them or borrow it. So heed with caution when doing so. As it says down here at the sign at the bottom, I want to circle this sign. This is a key factor that you need to understand in doing so. Right here, bam, last resort. Use as your last resort to get that business established. Important part to remember here is that you want to put all agreements in writing. Put them in writing right there. Put those in writing so there's no misunderstanding. That's the key thing you need to know here. Put it in writing. Stipulate the loan period, payment schedule, the interest, because it's in writing so both parties understand, so there's no confusion. So they know when they're getting paid. They know how much interest they're going to make long term, and everything is stipulated right there in front of them. Let's go to the next slide. Okay, capital source, supplies, and owners. Key thing here, you can get loans for inventory equipment. That's why I put over here, say we're going to start agriculture business right here, and you see that we got the farm trucks right here. Bam, right here. We got to get the farm equipment going. My circle is way off. Okay, you can get from your suppliers. You can get a loan to make payments on it with low interest rates. Sometimes right now you can see 2, 3, 4%, depending on the type of loan you get, and that's a source of capital and borrowing to pay over a time period. Another great option is down here is this wonderful lady that you see as the example of a previous owner. You're buying a business and you don't know much about it. You just know it's something that you want to get into. So you want to get an automotive industry. You always want to own an automotive shop. So you always want to own a beauty salon. Say anything in these trade fields. You want to own one. You want to do it. One's up for sale. You buy it, but you don't know much about it. A lot of times you can use these previous owners as partners to get started. They're going to help you, guide you through the way. They're going to show you what you need to do. They'll help sometimes with insurance coverage. Sometimes they'll help you show you the ropes, all different things they can do. And they'll help you be the partner at the beginning. And then once you get established, get going, you walk away, they'll walk away. That is a key thing to understand about previous owners. The main thing is what? They help give you better payments, low interest rates at the beginning versus going to the bank. And that's all we're going to talk about today. So if you got any questions, send me a message, like, subscribe,